Farmland is the new housing bubble, and it will crash your grocery bill. Farmland is the new oil. The voice on the investor call says, while a tenant farmer stares at an automated lease termination email, payment flagged by a dashboard, acreage reassigned by software. Grocery prices just jumped again. His kids ask if they're moving. Here's the question that cuts through the spreadsheets. What happens when your food supply becomes a financial product? The stakes are close to home. Your bill at checkout, fragile rural towns, even retirement funds hunting safe yield. We're going to trace how Wall Street turned soil into a ticker, why prices decoupled from crops, and how that can crash your grocery bill. Control the land, control the food chain. The new landlords don't wear boots. They wear fees. Pension funds, farmland REITs, private equity vehicles, and billionaire family offices buy parcels by the 1,000 acres and talk in portfolio terms. Diversification, duration, cap rates. The language shifted first. People used to ask about rainfall and soil tilth. Now it's yield on capital, quarterly distributions, and geographic exposure. On earnings calls, farmland is a line item between warehouses and data centers. The crop is cash flow. On paper, it sounds prudent. Spread parcels across regions. Mix row crops with specialty orchards. Secure rents with multi-year leases. Harvest stability. But listen at the farm gate, and you'll hear the rub. The leases are shorter, the rents higher, and the flexibility thinner. A bad weather year that used to mean renegotiation now triggers a clause. Payment dashboards flag variance. The letter arrives. Due to performance metrics, we're terminating at season's end. This is the quiet reordering. Livelihoods ride the volatility. Landlords collect the stability. The farmer takes the weather, water, and input risk. The owner earns the dividend. The gap between them widens every time capital flows faster than rain. Meanwhile, concentration builds. A handful of public REITs assemble hundreds of parcels. Family offices stitch together contiguous blocks behind LLCs. Institutional managers raise real asset funds that pair farms with timber, water rights, and renewable leases. The pitch is simple: uncorrelated returns, inflation protection, limited supply. They're not making more land. It rhymes with an older slogan that once floated housing. What nobody talks about up front is the decoupling. In region after region, land prices climb faster than farm income. Rents follow valuations, not yields. Capitalization rates fall, even when per-acre profits stall. You see it in auction rooms where sales comps whisper to the next appraisal and the next loan. You see it in local banks quietly resetting credit lines off inflated comparables because everyone else did. And you hear it in farmer meetings where the only way to pencil rent is pushing for higher output with higher inputs: fertilizer, water, chemicals, chasing marginal yield on thinner margins. Control the land, and you don't just control the harvest, you control the choices upstream and down. Seed companies tie contracts to volume expectations. Processors prefer predictable throughput. Retailers want uniform product on schedule. The lease becomes a lever that pushes cropping decisions toward financial targets. Long rotations get shortened. Soil health practices lose out to seasons that can be modeled. Cover crops give way to continuous corn. Orchards planted for 20-year horizons switch hands on 5-year rent escalators. The clock speeds up. The ground is asked to keep pace. Meanwhile, something else is happening in the background. Retirement money, the kind meant to be dull and dependable, is hunting yield in a world of low rates and restless markets. Real assets feel safe. Farmland sits atop that list with glossy charts showing smooth historical lines. The fee structures reward asset growth over patience. Managers gather acres because AUM pays today, soil health pays later. In that calculus, longer leases tied to regenerative metrics lose to shorter leases with ratchets and CPI adders. Stability is engineered at the top and squeezed from the bottom. A microstory: an almond grower in the Central Valley misses a rent step-up after a heat wave knocks production. The fund's model expects rising cash yield. A performance variance triggers a review. The grower proposes a soil moisture investment and a 2-year rent freeze to recover. The lease template doesn't allow it. By harvest, the parcel is reassigned to a larger operator who accepts higher rent and promises aggressive yield via more water. The risk shifts to the aquifer. The spreadsheet stays whole. From the grocery aisle, this sounds distant, but the price you pay is downstream of these contracts. When rents escalate, Operators pass costs into bids for inputs and into the prices they must take from processors. When flexibility shrinks, farms can't pivot away from stressed crops, so supply shocks hit harder. When ownership consolidates, regional failures amplify because the same financial terms sit on many fields at once. All of this feeds a larger open loop. Land prices drifting away from the income that land can produce. It doesn't snap in a single moment. It stretches season after season as stories of appreciation justify more buying, and more buying validates higher appraisals. Confidence stacks on confidence. To understand how that loop formed and why it's so stubborn, we need to go back to the last time an essential asset was repackaged as a safe, tradable instrument. We've seen what happens when use value, shelter, or in this case, food, gets subordinated to financial yield. The mechanics didn't start on a farm. They started in a mortgage office. The 2008 Playbook reappears in dirt. The rewind takes us to a familiar place. A simple asset turned into complex paper. In housing, mortgages became MBS. In farmland, acreage becomes shares in REITs, units in private partnerships, slices in index funds. The promise is the same: safe income, low volatility, diversification. And the engine underneath is leverage rising on the back of rising appraisals. Here's how the ladder forms. A fund buys 5,000 acres. Appraisals tick up because other funds just paid more down the road. The portfolio's net asset value rises. That higher NAV supports a bigger credit line. The fund borrows against the appreciated land to buy more land. Each purchase prints a new comparable that raises the next appraisal. It feels like disciplined diversification. It behaves like self-referential price discovery. This is the moment everything changed in housing too, when use value lost the steering wheel. On paper, risk is dispersed. Corn in the Midwest, almonds in California, berries in Florida. But the real exposures rhyme: rainfall patterns that sink across regions, input costs that move with global energy, commodity prices that slump together when demand weakens. Diversification looks elegant in a deck. Concentration hides in the weather and the water. Meanwhile, the slogans carry the psychology. They're not making more land, inherits the job real estate always goes up once did. It isn't a data point, it's a story that invites capital to ignore income. In the early 2000s, homeowners became collateral. Today, farmers renting land are the shock absorbers. If yields drop, rent still climbs because rent chases valuation. If margins compress, lease churn replaces relief. The stabilizer bar in this system isn't forgiveness, it's replacement. Watch the product menu expand once price detaches from use. Public farmland REITs promise dividends from seasonal rents. Private funds promise total return from appreciation plus cash flow. ETFs track farmland indices constructed from appraisals and transactions that earlier funds influenced. Crowdfunding platforms fractionalize deeds, offering access to the asset class. Tokens appear, granting tradable exposure to a parcel the buyer will never visit. Paper multiplies faster than crops. The safety story leans on history. Charts of farmland returns that look smooth next to stocks. The smoothness is a function of appraisal-based valuation, not minute-by-minute price discovery. That's comfortable in calm years and dangerous when liquidity is needed. In 2008, securitized housing promised stability through aggregation. The risk, pooled and sliced, got bigger than anyone's arms. Here, the pool is smaller, but the spiral rhymes. Income lags valuation, confidence stacks on confidence. Here's a micro-scene that explains the mechanics. A regional lender extends a line to a farmland partnership using recent auction comps as collateral support. The comps came from two funds bidding against each other with low-cost debt. 6 months later, rates move up and input prices bite. The partnership's debt service coverage thins. To protect covenants, they push rent across the portfolio and list a non-core parcel. The parcel sells lower than the last comp. The lender tightens advance rates. Now every acquisition model needs a higher rent to pencil. The loop tightens around the operator, but the headline still says agricultural alpha. Paper diversification cracks under synchronized shocks. A drought band can stretch across multiple states. A trade policy shift can collapse prices across grains. When those shocks hit, the REIT still files a dividend, but it's financed by selling a tract or drawing on credit while waiting for appraisals to catch up. That's the quiet mismatch between quarterly promises and seasonal reality. Another echo is moral hazard. In housing, originators earn fees up front and pass the loan along. In farmland, managers earn management fees on assets under management, plus performance fees on appreciation. The incentive points toward gathering acres and marking them higher, not toward anchoring rents to farm income or extending long leases tied to soil metrics. If fundamentals wobble, the parcel can be sold to the next buyer who believes the chart. There's a claim that farmland isn't as leveraged as housing was. That's true on balance sheet for now, but exposure is leveraged too. Pension funds counting on a steady 6 to 8% real asset sleeve can't afford a flat line. If price appreciation stalls, redemptions tug at open-ended vehicles. To meet withdrawals, funds sell into a thinner bid. Discounts show up. Appraisals chase prints down, and bank covenants start whispering. The fragility isn't only debt service, it's promise service. What nobody knew in the early innings was how quickly financial products would outrun agronomy. The lease template shrank the planting horizon. The dashboard turned weather into variance. The index turned land into a number. Once that translation happens, the same gears that spun in 2008 begin to turn in soil. The trigger isn't mysterious. A rate spike, a commodity slump, a cluster of droughts, or redemption gates pulling liquidity out of stable funds. To see where it leads, follow the incentives. If a parcel throws off less rent than modeled, raise rent or rotate tenants. If the model misses appreciation, borrow less and buy fewer acres, or more often, sell something to hit targets. Every action is rational inside the fund and heavy outside the fence. The farmer shoulders the variability. The system, for a while, looks fine. This is the echo we're living through, familiar architecture wearing different boots. And once new paper can be printed on land, more paper will be printed. Slicing the soil, REITs, funds, ETFs, tokens. Once price detached from use, products multiplied. The first cut was the Farmland RE. It looks simple. A company owns fields, leases them to operators, and pays shareholders dividends from seasonal rent. On earnings calls, executives walk through portfolio composition. Almonds here, berries there, corn and soy in the Midwest. Then showcase dividend coverage like they're discussing apartments. The calendar is agricultural, but the cadence is financial. Rents land in quarters. Guidance sets the tone. The soil becomes the substrate for yield. Inside the REIT model, seasons are smoothed. A drought in one county is offset by an orchard harvest in another. That smoothing is the selling point. Investors aren't betting on a single farmer's year. They're buying the idea that farms, averaged, behave like a slow, reliable bond. Meanwhile, portfolio cosmetics matter. Swapping a marginal parcel for a core, tract upgrades the slide deck, even if the farmer on the ground loses a long lease. The quarter wins. The rotation shortens. Private funds take the next slice. Limited partners commit capital to multi-year vehicles promising total return, appreciation plus rent. The pitch decks are polished. Low volatility charts, inflation hedges, correlations near zero. Managers lay out pipeline maps of target counties, cap rate assumptions, exit strategies. Fees ride on assets gathered and performance marks. The play is to buy below appraisal or create value through retenanting and water optimization. In practice, that can mean clearing families with weak balance sheets and bringing in large operators who accept higher rent and tighter terms. Crowdfunding platforms push the door open to smaller checks. Own a fraction of a farm, the websites say. The farm becomes a screen of numbers. Acres, tenant, expected cash yield, target IRR. Investors wire $10,000 to a special purpose entity that holds a deed and services a lease. Distributions show up in dashboards. Farm updates arrive like quarterly newsletters from a tech startup. Ownership turns digital. Accountability turns distant. Then come the indices and ETFs. A benchmark is built, often from appraisals, private transactions, and the reported values of public vehicles. And an exchange-traded fund offers daily liquid exposure to farmland performance. Liquidity changes behavior. Price discovery starts happening in the ticker, not the field. A bad crop year doesn't move the ETF much if sentiment stays warm. A rate hike can sink it even when tractors are running and yields are steady. The signal gets noisier, but the money gets faster. Tokenization is the latest layer. A single parcel is split into digital tokens that trade on secondary platforms with near-instant settlement. The narrative promises democratization and liquidity. The reality is that price starts responding to trading dynamics and marketing cycles more than rainfall and crop rotation. Liquidity chases attention. Attention chases news. A viral post about owning a slice of America's heartland can lift tokens even if the tenant just renegotiated rent down after a frost. Underneath all of it sits a simple truth: liquidity changes price. The more ways there are to buy exposure, the more buyers arrive, and the more the last price becomes the next appraisal. That pushes cap rates down. When cap rates fall, the only way to maintain the same cash-on-cash return is to raise rent or lower costs borne by the tenant. Costs don't vanish, they move. They move into the operator's margin, into input bids, into the rigidity of cropping plans, and eventually into the prices downstream. Fee incentives nudge the system. Management fees are calculated on assets under management. Performance fees clip a share of appreciation. Retenanting or reappraising can lift NAV faster than improving soil organic matter. Leasing to a processor affiliate or layering a solar option can juice other income and freshen slides. Over years, that tilts decision-making towards short-term financial optics. Cover crops become a talking point, not a habit, when a one-year lease renews with a rent escalator and KPI triggers. Diversification, on paper, masks correlation in reality. Almonds and corn don't share a market, but they share water stress and financing costs. A drought ban can dampen cash yields in multiple counties at once. A rate hike can compress valuations across every product that references farmland. The ETF, the REIT, the token, the crowd-funded parcel, they feel different in a brochure. They move together when the macro tide turns. There's a scene that captures the shift. A small operator sits across from a fund asset manager to discuss a lease renewal. The farmer asks for a longer term to justify a cover crop program and a drip upgrade. The manager slides over a template with a 2-year term, a rent ratchet, and performance thresholds tied to yield. It's what our investors expect, he says. The farmer can't finance the upgrade on a 2-year horizon. The land loses a decade of soil health in exchange for a cleaner dividend story. As rates rose in the early 2020s, the slicing met resistance. Borrowing costs climbed and models tightened. Funds responded by turning more parcels, pushing more rent, and experimenting with add-on revenue. Data licenses, water banking, ancillary easements. Products that promised liquidity met a price that didn't bend easily without changing lives on the ground. The story of stability kept playing. The instruments kept trading. But every slice carried the same root dependence. Someone had to farm, in thin margins, on shorter time. And that's the quiet pivot point. When liquidity drives valuation more than yield, the next shock doesn't just mark prices down on screens. It lands in lease renewals, in forced crop choices, and in the aisle where your total goes up before you know why. Interest rates and the new farm debt trap. While products multiplied, one quiet variable reset the math: the price of money. In the low-rate era of the 2010s and early 2020s, farmland felt like a cheat code. You could borrow cheaply against stable collateral, lock in spreads with rent, and let appreciation do the heavy lifting. Debt service barely nibbled at cash flow, and appraisals kept stepping higher, making yesterday's leverage look conservative. That comfort disguised how sensitive the whole stack was to the cost of credit. When rates rose, the first pinch surfaced in margins. Funds rolling short-term debt faced higher coupons. Lines priced off benchmarks reset upward, slicing into dividend coverage. On the ground, that pressure translated straight into the lease. Rent escalators that once felt academic became non-negotiable. Renewal offers came shorter, 1 to 2 years, with higher base rents and CPI adders to protect the model. If a tenant balked, the asset manager called it retenanting risk and chased a larger operator who'd accept tighter terms. The balance sheet got relief. The farm's cushion disappeared. Meanwhile, bank lines were built on inflated comps. During the boom, appraisals leaned on sales set by funds bidding with cheap debt. Those prints fed loan-to-value ratios, which fed credit capacity. When rates jumped, those same lenders started stress-testing cash flows against higher debt service. Coverage ratios thinned. Covenants whispered. Advance rates ticked down. Suddenly, land that always comped had to stand on income, not stories. That's where the appraisal contagion began. One lower sale to meet redemptions or debt payoff reset the marker for a whole county. Debt layering made it worse. Farms weren't just collateral for farm operations, they were collateral for everything built on top of them. A fund might secure a revolver against its farmland portfolio, then pledge portions to back mezzanine financing for an acquisition, then carve out a solar option for extra income to cover the blended cost. Each layer assumed liquidity on demand. When borrowing costs rose and exits slowed, those layers tightened like a tourniquet. To free the limb, managers sold parcels fast. Fire sale discounts printed. Local lenders watching those prints adjusted underwriting. Neighbors saw their equity shrink on paper without a single furrow touched. That's the echo of the 1980s farm crisis, playing in a financialized key. Back then, rate hikes crashed land values and wiped out thousands. Today, the mechanics rhyme, but the holders are broader. It isn't just local banks and families, it's pensions, REITs, insurers, and sovereign funds. When they face pressure, they don't call the seed rep, they call the redemption desk. Meeting withdrawals forces sales, even in regions mid-harvest. The selling doesn't ask if a drought just knocked yield or if a water district cut allocations. It hits market and moves the number. Here's how the trap closes on an operator. A tenant signs a 3-year lease in 2021 at a rent that penciled with sub-3% money and moderate input costs. Fertilizer spikes, diesel climbs, rates jump. The fund's debt service bites, and the lease has a CPI kicker. Year 2 rent rises while net price for the crop slips. The farmer asks for relief or a longer term to invest in efficiency. The answer is a shorter renewal at a higher base or a notice to vacate. The farmer leans on a local lender to bridge the gap. That lender is marking down collateral after a nearby sale cleared 12% below last appraisal. The line doesn't stretch. The farmer trims inputs, chases yield, and hopes for rain. One weather miss, and the lease churns. The land doesn't change hands in a deed room. It churns in a spreadsheet. Rate hikes also rerouted capital flows across the portfolio. Money that once chased farmland on the promise of smooth, bond-like returns found actual bonds paying more with less hassle as rates climbed. Open-ended vehicles felt it first. When inflows cooled and some investors asked for cash back, managers raised gates or sold properties. Both options radiated stress. Gating told the market liquidity wasn't what the brochure implied. Selling at a discount established new comps. Either way, the cost of capital got heavier for the next buyer, and rent needed to rise again to make the pro forma hold. Meanwhile, insurers and pensions that had framed farmland as duration hedges found duration risk hiding in the leases. Rising rates cut the present value of appraised income streams, just as rent affordability hit a ceiling. The lever left was term, shorten leases so they can be repriced faster. But shorter terms kill long horizon practices that protect yield. Rotation, cover cropping, precision water investments. The soil becomes a quarterly surface, not a generational asset. That trade shows up later in volatility. Fields get riskier as financing demands more stability. Appraisal contagion spread through credit committees. Regional lenders who once leaned on a stack of strong comps saw the top comp turn stale and the freshest one arrive with a distressed footnote. Seller motivated due to fund restructuring. Committees shaved loan-to-value by 5 points and raised rates by 150 basis points. That seeped into operator lines, input financing, and equipment loans. Every notch up in cost tightened decisions. Which acres to plant, which inputs to skip, which field to leave fallow. The aggregate impact wasn't just financial pain. It was production choices made under credit constraints, not agronomy. So who kept belief alive? The same voices that framed land as an inflation hedge rewrote the sermon. Higher rates create disciplined buyers. Long-term scarcity still wins. Conferences and decks refreshed the story with new phrases. Resilient cash yield, drought-adjusted underwriting, water-smart alpha. The narrative reassured the allocators whose capital set the bid. But out past the slides, the rate regime had already changed the rhythm. Money moved slower, leases moved faster, and the gap between a farm's income and its imagined value narrowed the hard way. The trap isn't complicated. Cheap money let financial owners stack leverage on land that produced steady, seasonal income. Expensive money forces that stack to shrink. Shrinking stacks don't absorb risk. They export it, to tenants, to local lenders, to grocery aisles months later. And while sermons steady hands for a quarter, the collection plate is passed downstream. Selling scarcity, conferences, decks, and AG alpha. While rates were tightening the screws in the fields, The story stayed glossy in ballrooms cooled to 68 degrees. At farmland investment summits, the first slide is always a sunlit field. Then come the curves, returned since 1992, volatility bars half the size of equities, a tidy line beating inflation. The voiceover swaps agronomy for finance, uncorrelated, durable, essential. Scarcity becomes the headline. They're not making more land, a presenter says, and 100 pens move at once. Get this, the pitch never mentions mud. It speaks in abstractions, acreage units, sub-basin risk, drought-adjusted models. An orchard becomes a yield vector. A county becomes a basis point. Agricultural alpha is the phrase that sticks. It promises something more than beta on a scarce resource, something earned through manager skill, better tenants, smarter water, proprietary data. Soil-based stability follows as the anchor. The earth itself is framed as a balance sheet that composes itself slowly, predictably, safely. ESG language wraps the structure. Decks cite sustainable practices, carbon potential, habitat corridors. A bullet point flashes, regenerative pilots on select tracts. But read the footnotes. Pilots don't change fee math. Management fees still accrue on assets gathered. Performance fees still clip appreciation. Sustainability lives in the paragraphs. Finance lives in the terms. The structure doesn't bend for cover crops if a one-year lease with a CPI ratchet prices cleaner. Data helps tell the story. Advisors cherry-pick windows when farmland stair-stepped up while stocks whipsawed. The chart looks calm because appraisals lag. That lag is sold as low volatility. In Q&A, someone asks about profit per acre. The answer switches to rents and cap rates. Income on the farm is inconvenient. Income to the fund is the product. If per acre profits flatten while valuations rise, the deck reframes it as capital deepening and portfolio optimization. Managers lean on comparisons. Soil values next to gold reserves. Acres mapped like pipelines. A speaker draws a line between grain demand and demographic trends. 9 billion people need to eat. Therefore, the land that feeds them earns a premium forever. It's tidy. It leaves out the hard edges. Aquifer caps, salinity creep, input cost shocks. We underwrite water, the slide says. The line you don't see is the one on a farmer's renewal, shorter term, higher base, KPIs that move faster than rain. The moral hazard sits off stage. Fees are earned whether the tenant thrives or churns. A manager says, we focus on tenant quality, meaning operators who can absorb rent hikes and carry inventory. Smaller families, the ones who invest sweat in soil over decades, don't fit the debt profile. Retenanting a tract and marking rent up 5% counts as value creation. Soil organic matter doesn't make the quarterly email. Conferences are where faith gets written. Allocators need a narrative that justifies an entry point, a pacing schedule, and a number for their board. Scarcity, stability, and story do that work. A CIO hears bond-like with upside and slots farmland between core real estate and infrastructure. The line item's job is to be quiet. The irony is that the quiet depends on loud pressure outside the slide deck, rent escalators, term compression, and covenants that visit the farm gate as emails, not neighbors. Here's where it gets practical. Decks include case studies. WaterSmart Alpha lifted NOI by installing drip systems and repositioning tenants. Translation: capitalized a basic irrigation upgrade and swapped a tenant who asked for a longer lease for one who didn't. Another slide touts resilience through optionality. Solar overlays, agrivoltaics, logistics adjacency. That optionality reads as diversification. On the ground, it nudges land away from crops when margins tighten, reducing local supply and pushing volatility into prices. Data cherry picking shows up in regional maps. Midwest core yields a steady rent roll, while specialty crops enhance return profile. Specialty crops also amplify risk, water, frost, pests, yet the composite chart smooths it. The smoothing happens because appraisal marks don't swing like a futures screen. In lean years, funds sell a tract quietly, keep the dividend steady, and move on. The story holds in the room because the room isn't priced by drought. ESG spin isn't all smoke. Some funds do push better practices, but incentives still point to AUM. A manager who turns down a hot county with stressed water because the aquifer is wobbling earns no fee for prudence. A manager who wins the tract at a thin cap rate and raises rent to fit the pro forma earns both fees and praise for conviction. The discipline that matters for soil runs on decades. The discipline that matters for DEX runs on quarters. AG Alpha gets the last word because it flatters both sides. The manager is a steward, not a speculator. The allocator is solving for planet and pension. The farmer is a KPI. That's the fracture. When the sermon ends and the capital flows, the terms must land somewhere. They land on shorter leases, higher rent, and rigid benchmarks that tighten when weather or trade moves the wrong way. Those pressures don't show on a slide, but they ring at checkout later. The scarcity story sells because it's partly true. Land is finite. Water is finite. Food demand is inelastic. But scarcity priced as certainty turns fragility into a yield strategy. Conferences keep the music playing. DEX keep the steps memorized. AG Alpha keeps the hope alive that this time, finance can smooth seasons. Out in the fields, seasons still call the tune. And the next verse is already loading into models. On the ground, how financialization warps farming. Walk the rows, and the terms show up like footprints. Shorter leases first. A 1 year with a ratchet. Maybe 2 if the rent escalator bites a little harder. That horizon changes everything. On a 12-month clock, you don't plant windbreaks, you don't rebuild terraces, and you definitely don't sink money into slow payback practices like cover crops or deep-rooted perennials. The soil becomes a temporary surface to be pushed for yield right now, because next year the rent resets, and the tenant might not be you. Rent escalation does the rest. When valuations sprint ahead of farm income, the spreadsheet solves by hiking rent. Operators try to pencil it. The math forces a pivot toward high input, high output bets. More nitrogen to chase bushels. More irrigation to secure weight. More aggressive planting windows to squeeze a second crop. The spread between the cost of inputs and the expected price of the crop narrows, but the lease just wants the check. If the season cooperates, you survive. If it doesn't, the clause enforces. Algorithmic enforcement is the new neighbor. Leases now carry performance KPIs that report into dashboards, yield targets, moisture thresholds, delivery timelines. Miss 2 benchmarks and a warning pings. Miss a payment date, and the system generates a termination notice before the farm office opens. There isn't a conversation under a shade tree about why the canal ran short in July. There's a PDF with a box to tick if you want your security deposit reviewed. Efficiency replaces empathy because efficiency meets the quarter. So cropping choices start coming from spreadsheets. A fund underwrites a tract assuming a certain water profile. The model pushes growers toward varieties that hit those modeled yields. That can mean almonds over alfalfa in a stressed basin, or continuous corn instead of a soil-resting rotation, because the cash rent assumes year-round productivity. Water risk moves to the aquifer. Fertility risk moves to the topsoil. The balance sheet stays smooth until it doesn't. Here's a human vignette. A dryland wheat family in western Kansas hits a 2-year drought cluster. They've farmed that section for 3 decades on handshake renewals that turned into PDFs. The new owner is a fund that added CPI kickers. Harvest misses by 20%. The family asks for a 1-year rent freeze and a 3-year term to justify a no-till drill and stubble management that would help the soil recover. The asset manager sends a polite refusal. Our policy doesn't accommodate below-market rents. 30 days later, the lease is offered to a larger operator who promises to meet the KPI by adding a chem-fallow regime and pushing acreage harder in wet years. The fund logs tenant upgrade. The family loads a second semi with equipment they hoped their kids would run. That churn has a cost you won't see on a deck. Shorter tenures erode local knowledge. Where the low spot floods first, which wind breaks protect tasseling corn, the specific field that needs a slower planter because of a soil seam. Those details live in a person over time. Lease churn bleaches them out. Mistakes get made, corrected, and made again because the operator changes before the learning sticks. The squeeze extends to rotations. A 5-year plan that includes a cover crop year and a lower revenue legume can build fertility and suppress pests. But a 1-year lease with a rent ratchet demands the highest revenue option every season. That often means monocropping and heavier chemical dependence. The soil takes the hit in structure and biology. Yields can hold for a while with more inputs. Then a dry spring or a pest bloom cuts through the veneer, and the operator is left with both a weak field and a strong rent bill. Processing contracts feel the pressure too. Financial owners push for fixed delivery windows and volumes to match their cash flow needs. That rigidity trickles down into crop calendars. A processor wants uniform tomatoes every week in August, so growers plant to hit that window even if weather suggests shifting. If fields miss, liquidated damages clauses trigger. The farmer absorbs penalties. The fund still files a rent check. A quiet shift shows up in insurance. Some owners embed captive insurance into leases, mandatory products that cover certain risks, but exclude the ones the farm is actually facing. The premium becomes another fee stream upstream. The operator pays for a safety net with holes in the places the weather now tears. Technology arrives with strings. Remote sensing and moisture probes are useful, but when they're tied to lease KPIs, data turns into discipline. A dashboard flags evapotranspiration outside a band, and a notice goes out. The farmer explains a gust front and a sandblasted edge. The system registers noncompliance because the band is the band. That rigidity pushes behaviors that meet the metric, not the conditions. Extra irrigation to hit a moisture target even when a cool front is 24 hours out. Water use climbs to satisfy a spreadsheet. The bigger operators thrive for a while. They can absorb rent hikes, negotiate volume discounts on inputs, and spread compliance staff across counties. Scale buys time. It also compresses diversity. A region shifts toward fewer crops under fewer companies, all walking the same tight lease line. When a shock hits, hail, a trade hiccup, a water cut, the impact multiplies because everyone made the same bet under the same terms. Meanwhile, the social fabric thins. Local equipment dealers lose service contracts when families exit. Co-ops shrink. School rolls fall. County tax bases wobble when valuations stall or sales clear below appraisal. The financial owners don't attend the budget meeting when the school asks why the bus route is shorter. They file an NOI update. None of this is inevitable. It's mechanical. Short-terms push short-term decisions. Rent escalators push input intensity. Dashboards push rigidity. Each step is rational on a balance sheet and costly in a field. And those costs don't stay put. They walk off the farm in the form of tighter supply, more fragile output, and prices that carry a volatility premium you meet at the register. From field to aisle, how the bubble hits your grocery bill. Here's where the contracts turn into prices you can feel. Start with cost pass-through. When land valuations run ahead of farm income, rents chase appraisals, and operators have two levers: push for higher yields or push costs forward. Inputs rarely get cheaper on command. So the rent and financing burden get built into the price floor farmers require from processors, packers, and buyers. Some seasons, futures markets don't cooperate. The gap shows up as tighter supply, thinner bids, and a quiet tax called volatility that retailers price in before you walk through the door. Finance-driven consolidation amplifies every shock. When a region tilts toward a few large operators under similar lease terms, their decisions sink. A heat dome hits, water allocations dip, and the same rent escalators push the same crop choices at the same time. Instead of a patchwork response, you get a chorus. Processing plants see uniform shortfalls, spot markets tighten. And because ownership is concentrated, a fund navigating debt coverage across multiple counties makes portfolio decisions that ripple through entire supply lanes. Pause replanting here, accelerate sales there, hold inventory if a bond covenant is close. Those choices aren't about food, they're about financial timing, and the aisle feels the timing lag. Contract rigidity turns agronomy into a metronome. Processors and retailers favor fixed volumes and schedule certainty, so upstream contracts lock in delivery windows and specs. Leases then mirror those demands with KPIs and penalties. In a normal year, the machine hums. In a weird year, the kind climate makes more common. Those fixed promises force bad fits. A grower can't pivot out of a failing crop without breaching terms, so they double down and miss anyway. The penalty lands. The next negotiation resets price expectations higher to cover future risk. The premium for predictability becomes part of the sticker. Then there's the multi-asset pivot. Financial owners prize optionality. If a crop cycle underperforms and power prices rise, a solar lease on marginal acres may beat soy. If a highway expansion creeps closer, a logistics pad outruns wheat. On a spreadsheet, this is portfolio optimization. On the ground, it's fewer planted acres exactly when weather or trade squeezes supply. The local cannery faces a shortfall and pays up to secure throughput. That higher procurement cost filters into wholesale pricing and rides with the pallet into your store. Retailers don't wait to be surprised. They hedge risk. When upstream looks jumpy, rents ratcheting, leases shortening, redemptions whispering, procurement teams build buffers. They expand contracts across geographies, add premiums for priority loads, and hold extra inventory where cold chains allow. Insurance gets layered too, from cargo to business interruption. Each layer has a price. The grocery aisle becomes a place where you pay not only for tomatoes, but for the right to not see an empty shelf during a bad month. Call it a stability surcharge. You won't find it on a sign, but you'll feel it across categories. A microstory ties it together. A Midwestern cannery sources sweet corn from a belt of farms, many now owned by funds that tightened leases after rates rose. A June storm shreds stands. Growers ask to switch acreage to a faster maturing variety. Lease KPIs don't allow the change without a fee, and the processor's contract requires August volume anyway. The mismatch cuts deliveries by 18%. To fill orders, the cannery buys from 2 states away at rush freight rates. Wholesale prices bump, and a retailer facing thin margins lifts shelf tags across the canned aisle, not just on corn, to smooth the optics. You pay the difference in October, long after the storm headlines fade. Another path runs through inputs. Consolidated landlords negotiating at scale sign supply deals with input providers and logistics firms to lock pricing and priority. Those deals often include escalators tied to indexes and freight. When fuel spikes, the clause triggers. Input costs climb industry-wide, even for independent operators. The average cost to produce a crop moves higher, including for the farms that sell into store brands pitched as value. The rising tide here doesn't lift. It thins margins or raises tags. In a quarter under pressure, tags move. Food categories don't move in isolation. Finance treats farmland, storage, and insurance as neighbors. Private equity's software moats in self-storage and embedded tenant insurance trained investors to monetize captivity and default risk. The same playbook leaks into food distribution. Warehousing with dynamic pricing, captive refrigeration insurance, and penalties for scheduled deviation. Those fees live in the cost of getting food from field to shelf. When upstream fragility increases, so do downriver fees, and the final price blooms with small, invisible petals. Some argue competition will blunt this. A discount chain can undercut by squeezing vendors harder, but they face the same upstream structure. Fewer operators under tighter leases, processors juggling fixed volumes, and logistics contracts priced for a world that breaks more often. The result isn't uniform inflation, it's jagged. Strawberries cheap one week, missing the next. Eggs flat, then plus 30% on a bird flu whisper. Retailers build that jaggedness into average margins, which pulls the whole basket up a notch. Here's the uncomfortable loop. Higher grocery bills justify the scarcity narrative that keeps capital crowding into farmland as a safe hedge, which supports valuations that push rents, which raise production costs that show up as higher grocery bills. The bubble feeds your receipt, and your receipt feeds the bubble. Breaking that loop means putting you's value back in charge, something the spreadsheet resists until the numbers force it. The subscription life, storage, insurance, and control points. While farmland turns into paper, another quiet empire grows on the edges of daily life. Places where ownership becomes a monthly fee and risk becomes a product line. Self-storage is the clearest lens. The buildings look plain, but the business is engineered. Private equity bought facilities at scale, then bought the software that runs them. One platform now controls the operating system for thousands of sites. The website you click, the price you see, the payment processor that charges your card, the tenant protection plan that appears at checkout. Dynamic pricing sits at the core. Algorithms adjust rates by the week, sometimes the day, nudging each unit toward the maximum a neighborhood will tolerate. Move-in discounts pull you in, mid-contract increases keep you paying. A late fee schedule locks in habit. The software's default is to push small, frequent price steps that most people won't contest. The operator's revenue grows without building a single new hallway. That's how a plain corridor starts acting like a subscription. Insurance is welded into the flow. Many facilities require proof of coverage, then happen to offer a captive policy at the counter. The fee reads small, $8 or $12 a month, but the margin is thick. Claims are narrow, exclusions are broad. If a storm hits and your loss falls outside the list, the policy stands there like a turnstile. The landlord collects the premium flow. The risk sits with you. It's familiar math. Protection becomes a product. Certainty costs extra. The owner monetizes the fear of a rare event. The control point is the platform. Payments, pricing, insurance, marketing, one stack. Consolidators don't just own doors. They own the decisions that touch every renter. Miss a payment twice, and a sequence triggers. Lock, lien, auction. The system is designed to capture revenue on the way in and on the way out. The stories you hear, someone's keepsakes sold over $100 debt, aren't glitches. They're revenue models that treat sentiment as stickiness and default as upside. Move to home insurance, and the pattern repeats. Financial players unbundle risk into yields. Premiums get priced by zip code and climate trend. Deductibles creep up, exclusions expand. The monthly number can stay moderate while the useful protection shrinks. Profits live in the spread between collected premiums and paid claims, and in the float, money held and invested until checks go out. In a volatile climate, pricing models adjust faster than regulators. The result is an insurance product that behaves like a subscription with rising friction. You pay more for less certainty, then meet a clause when you need help. Software moats reinforce everything. Payment rails add convenience fees if you don't enroll in autopay. Portals charge for document access beyond a baseline. Customer support turns into tiers: free chat, paid phone, priority response for a monthly add-on. Each small price is nothing. Together they're a toll road through daily life. The leverage isn't in concrete or call centers. It's in defaults set by code. The vertical integration thesis ties it all together. By the choke points, where people and goods must pass, and layer fees. Storage captures possessions between moves. Insurance captures fear between quiet years and bad ones. Payment software captures rent, dues, and penalties. The portfolio reads like a map of everyday necessities. Investors call it resilience, sticky demand, low churn, long-lived assets. The social translation is simple. Your life becomes a sequence of subscriptions, and your margin for error becomes their margin. Here's a micro-story. A family downsizes after a rent spike and stores furniture for a few months. Move-in rate, $79. By month 4, it's $99. The facility requires insurance unless proof is uploaded. An added $12 appears. A missed payment triggers a $20 late fee and a lock. The grace period ends on a Sunday. Unlock fee, $25. The family pays to avoid the lien letter. 6 months later, they're out $800 to store a $600 couch. The platform logs, lifetime value exceeded target. These habits bleed into food logistics. Cold storage operators adopt dynamic pricing for pallet space. Miss a delivery window and pay a penalty. Need emergency capacity during a regional shortfall? Surge pricing applies. Embedded insurance covers spoilage with carve-outs that exclude the common edge cases. Processors pass those costs along because they have to. Retailers blend them into shelf tags because they can't swallow the volatility alone. None of this requires a villain. It requires incentives tuned to fee growth and churn management. Private equity funds call it value creation. CFOs call it ancillary revenue. Customers call it the cost of living. On a balance sheet, the model looks safe. Subscription revenues, diversified across geographies, with low capital intensity once the platform is built. In a household, it feels like sand in every joint. The playbook continuity matters for Farmland. The same investors who learned to monetize storage defaults and insurance exclusions bring those instincts to fields and warehouses. Mandatory coverage in a lease. Penalties for timing variance. Dynamic pricing for capacity. When upstream grows more fragile, downstream control points harden. Fees rise first. Prices follow. And what started as a story about
Who owns
farms
the
ends up
harvest?
as a
Pension
monthly bill
sovereign
that
funds
never
and
sits
you.
still. Unknown to most people, the deed behind a field often traces back to a retirement plan. Teachers in Ohio, nurses in California, city workers in New York, through pensions and insurers, are partial owners of crops they'll never see. The logic sounded careful. Match long-lived liabilities with long-lived, stable real assets. Farmland fit the brief. So did timber, water rights, and infrastructure. Capital crossed borders, bundled by asset managers who promised dull, dependable lines on a quarterly page. From their perspective, this wasn't a land grab, it was risk management. A 6 to 8% allocation to real assets was supposed to smooth the ride when stocks snapped. Consultants showed the charts. Farmland returns that looked calm next to equities inflation protection, low correlation. Sovereign wealth funds read the same decks. European insurers did too. Policy boards nodded. Mandates moved. A manager raised $1 billion for Farmland Fund 2. Another launched a global AG vehicle with water overlays. The acreage marched into portfolios. Meanwhile, something else was happening across town. The same funds promising quiet income layered leverage, shortened leases and tightened covenants, exporting weather and market risk to tenants and communities. The pensioners never saw the clause that cut a family's term to a year. They saw a line that beat inflation by a point. That gap, between who bears the risk and who reports the return, stayed hidden until the macro turned. Plateau risk is where the narrative thins. If appreciation slows, the defined return math stops working. Many vehicles counted on rising appraisals to lift total return above what seasonal rent could cover. When price gains stall, the yield that looked safe evaporates. Open-ended funds feel it first. Some offer quarterly redemptions. When more money wants out than in, managers sell. They don't sell the worst fields. They sell the most liquid parcels, close to highways, near processors, places locals hoped would be stable. That selling pushes marks down for neighbors who aren't going anywhere. Redemptions cascade. A fund meeting withdrawal requests lists properties across counties. The prints come in light. Appraisers recalibrate. Regional lenders trim advance rates, citing market evidence. Operators refinancing lines meet tighter terms. Leases reprice with higher rent to patch the fund's coverage. And back at the pension, the quarterly report shows a small markdown, a footnote about portfolio rotations, and a plan to lean into the opportunity. The word for that loop is distance. Cross-border capital magnifies the effects. A sovereign fund in Asia, paired with a North American asset manager, to own hundreds of parcels across multiple states. When their home currency swings or a domestic shock hits, they rebalance globally. That can mean selling farmland not because the soil changed, but because a macro switch flipped oceans away. Local prices absorb a decision made in a different language, on a different morning, off a different screen. There's another layer, feedback between lending and valuation. Funds borrow against their land at portfolio-level credit facilities. Banks look at appraisals to set covenants. Appraisals look at recent sales to set value. If redemptions force a wave of motivated sales, covenants tighten, which pressures funds to raise cash, which creates more motivated sales. The loop that once pushed prices up now runs in reverse. Families who never borrowed against appreciation watch the benchmark that sets their tax bill, and their potential buyer's loan move in ways that have nothing to do with rainfall. And still, the marketing stays disciplined. Managers tell fiduciaries they're rotating from appreciation-driven strategies to income resilience, emphasizing row crops over specialty, adding water-smart underwriting, partnering with anchor tenants. Some of that is real. Many operators do want longer terms and soil metrics, but fee math hasn't changed. AUM pays every quarter, patience pays later. If the pension insists on distributions, farmland becomes more liquid than it really is. So where do you fit? Your retirement account may hold a sliver of a fund that holds a sliver of a county. Your grocery bill reacts downstream when those funds defend yield with rent or defend liquidity with sales. You pay twice. Once as a saver chasing stability that depends on appreciation, once as a shopper paying for the volatility that stability creates. It's not a conspiracy. It's an alignment of incentives that ignores the field until the field pushes back. There's a micro scene that brings the abstraction home. A schoolteacher opens a pension statement, steady contributions, a safe allocation to real assets. That same quarter, her town's farmland sells at a discount to meet redemptions. The sale resets comps. A neighbor's refinance fails. A tenant's lease renews higher to cover the fund's debt service. 6 months later, the teacher's grocery budget is tight. Her pension benefited from the story that set this in motion. Her paycheck absorbs the aftermath. 2 columns, 1 life. The question isn't whether pensions should own land. The question is how they own it. Long leases tied to soil health and income, transparent fee structures, downside sharing when yields collapse. Those choices exist. They're quieter in ballrooms, but louder in counties. If ownership remains a spreadsheet hunting smooth lines, the harvest will belong to whoever writes the terms. If ownership remembers crops come before charts, the benefits can circle back to the people whose savings and suppers fund the system. fragility, climate, water, and uncorrelated myths. From the allocator's seat, farmland looks calm, lines on a chart that barely wiggle while equities thrash. From the field, calm is a rumor. Climate doesn't spread risk out, it links it. Drought bands don't respect county lines or portfolio maps. They march across states, syncing outcomes that decks once called diversified. That's the crack in the uncorrelated story, whether ties distant parcels together in the same bad way at the same time. Take the western half of the country in a hot, dry summer. Snowpack is light. Reservoirs sit low by May. Evaporation steals more than models assumed. Everyone with a water allocation sees cuts, staged or sudden. Almonds, tomatoes, cotton, different crops, identical constraint. On paper, the portfolio holds variety. In reality, the same constraint writes the same email to 20 tenants. Conserve, comply, deliver. Yields fall together. Cash yield to the fund shrinks in chorus. Water is the tightest vice. Aquifers that meant optionality, in prospectuses turn into depletion curves. Pumping caps arrive, first voluntary, then mandatory. A tenant who counted on groundwater to backstop a hot August gets told the meter stops at noon on Thursdays. The lease didn't change. The physics did. When water turns from asset to liability, the correlation coefficient jumps. Investors call it regime shift. Farmers call it a dry well. Meanwhile, heat isn't just stress, it's timing chaos. Crops that depend on night cooling to set fruit struggle. Heat spikes during flowering can erase a season's yield in 48 hours. Wind comes in at the wrong week and desiccates seedlings. These aren't tail events anymore, they're frequent visitors. Backtests that created tidy confidence intervals didn't include a decade where anomalies became habits. The model risk is simple. The past stops being an anchor. Trade shocks add another layer of synchrony. A tariff spat, a phytosanitary ban, or a demand slump overseas doesn't tap one county. It drains price across a commodity. Add leverage, and that price move travels fast. Funds that underwrote steady rent against a futures curve find the curve lower, the rent fixed, and the tenant squeezed at once. Paper diversification. Row crops here, specialty there, doesn't help when the macro turns every price the same color. Water governance amplifies fragility. Rights are layered, riparian, prior appropriation, district allocations, groundwater adjudications. A parcel spreadsheet might list secured rights, but a court ruling or basin plan can re-rank priorities overnight. Junior rights vanish in a dry year. Senior rights face political pressure. When a district sets cutbacks, the pump stops without regard for KPIs. Debt service dates don't move. Here's a microscene. A grower in a sub-basin plans a rotation that rests soil with a lower water cover crop. The fund's lease KPIs expect yield on a schedule designed for a wetter decade. When the basin board announces mid-season cuts, the tenant asks to pivot. The algorithm denies the change. The farmer pushes a thirsty variety to hit contract specs and drains the allotment. Soil suffers. The harvest limps in. The lease renews shorter. The basin tightens again the next spring. That's correlation with the calendar. Insurance, the usual shock absorber, doesn't unhook these links. Crop insurance pays on formulas that lag reality and exclude compound failures. Excess heat, water cuts, and a wind event in the same window confuse coverage. Payouts keep farms alive, but they don't refill reservoirs or repair soil structure. Funds still need rent. Banks still need coverage. The operator stands between climate and clauses, and volatility climbs. Investors love the phrase uncorrelated, but uncorrelated to what and when? Appraisal-based marks move slowly until they move, which reads as low volatility until liquidity is required. Climate compresses the time between marks. A drought cluster triggers rent concessions in the real world, portfolio sales in the financial one, and appraisals that finally acknowledge both. The low-vol line becomes a step down. Suddenly, correlation to rates, energy, and climate shows up at once. There's also the spread between biological and financial. Time. Soil health is a decade story. Water tables recover if they do on multi-year scales. But leases roll annually, covenants test quarterly, investor calls arrive every 90 days. When timelines clash, the short one wins. Operators skip rotations that rebuild structure. They mine residual moisture. They defer repairs that harden fields against extremes. Returns look fine until the next hot spring takes the roof off. Trade policy turns correlation global. A bumper crop abroad plus a shipping bottleneck can slash prices here, just as a heat wave hits yields. The worst mix, low volume and low price, arrives more often than models suggest because climate and geopolitics don't coordinate with your base case. Layer in rising rates, and the floor under land values gets shakier precisely when operating income is weakest. The myth that farmland sits outside market noise kept money flowing. The reality is that climate and water are markets now, regulated, rationed, politicized. They synchronize outcomes across crops and counties. In that world, uncorrelated is a memory. The asset that looked like a hedge starts to act like a conduit. And when the conduit hums, it carries stress from field to fund and back again, faster than anyone rode into their deck. Crisis mechanics, how a farmland sell-off unfolds. The spark can be small. A rate spike lifts borrowing costs just as a dry spring clips yields. Or a commodity slump undercuts the price floor tenants need. Sometimes it's quieter. A wave of redemption requests hits an open-ended farmland fund after a rough quarter. Any one of these triggers starts the same chain. The first link is confidence, and it slips fast. Mark-to-market pain shows up inside covenants before it shows up in headlines. Portfolio-level credit lines test debt service coverage and loan-to-value ratios off the latest appraisals. When a fund misses dividend guidance, the lender asks for updated marks. Appraisers pull recent sales. One parcel, sold quickly to meet redemptions, clears 10% below last year's comp. That print travels. The updated appraisal trims value across neighboring tracts. LTV tightens. The bank cuts the borrowing base. Suddenly, a fund that looked comfortably financed needs cash. Cash comes from rent or sales. Rent can't rise in the middle of a bad season, so managers scan the portfolio for non-core properties to list. The ones with the most buyers go first. Parcels near highways, blocks with water infrastructure, fields next to processors. Listing signals uncertainty to locals. Bids come light, factoring in rate pressure and thinner cap rates. One sale at a discount resets appraisals again. The feedback loop picks up speed. Leases feel it next. Renewal packets arrive with higher base rents and shorter terms as managers race to reprice income to cover debt. Tenants running thin margins balk. Some walk. Asset managers call it re-tenanting risk and start swapping smaller operators for larger ones who can absorb terms for a season. The churn drains local knowledge and pushes input intensity higher to hit KPIs. Meanwhile, the fund's income line steadies for a quarter. The field's resilience drops for years. Fire sale dynamics begin when multiple funds face the same pressure. If redemptions spread, perhaps because another manager gated withdrawals, allocators raise cash by selling what they can. Parcels hit the market across counties at once. Buyers with cash, often consolidators or vertically integrated platforms, cherry-pick. They discount hard, citing rates, water, and transaction velocity. Families hoping to buy a neighboring field can't match speed or price. The strongest operators consolidate more. Everyone else watches the floor reset. Community fallout arrives in a second wave. County assessors adjust valuations after a run of low prints. On paper, tax bills fall next cycle. In practice, budgets already set on last year's roll face a gap. School boards trim routes. Road crews delay repairs. Local banks, exposed to operator lines and equipment loans collateralized by land, tighten credit after examiners flag portfolio marks. The co-op sees fewer pre-buys. The implement dealer lays off a tech. The sell-off isn't just dirt moving. It's the scaffolding around rural life thinning. Regional lenders get hit from two sides. Their farm borrowers ask for extensions because rent jumped and prices dipped. Their participation lines to farmland funds go on watch after appraisals fall. Credit committees respond by shaving advance rates and bumping interest spreads. New originations slow. Operators who could stabilize fields with modest investments, tile, drip, terraces can't borrow. Deferred maintenance becomes another kind of drought. Broader spillovers run through pensions and insurers. A farmland fund marks down 5% this quarter, then 3% next. The board asks questions. Consultants recommend trimming the sleeve. Managers sell more, reinforcing the slide. The same plan that owned farmland for stability meets instability created by its own exit. Meanwhile, consumers feel the echoes in aisles. Supply lags as churned leases reduce flexibility. Retailers pay premiums to secure volume, then spread the cost across categories. Prices rise unevenly, trust erodes evenly. In the midst, narratives try to catch up. Managers pivot their pitch to distressed opportunity funds. Consolidators raise capital to rescue assets. The cycle rebrands itself. On the ground, the next buyer resets leases, revises KPIs, and promises smarter water. Some deliver. Many repeat the terms with a lower basis. The pressure on tenants doesn't vanish, it just shifts hands. Here's a micro-sequence as the spiral tightens. A drought cluster hits a multi-state band. A large manager misses dividend guidance and lists parcels. 2 sales clear light. Appraisers remark a neighboring county. A regional bank trims a borrower's line and asks for a partial paydown. The farmer sells a combine and defers a cover crop. Yields suffer next season. The lease renews higher, shorter. The farmer exits. A platform buyer steps in, promises volume to a processor, and signs a solar option on the back 40. The fund patches its quarter. The county loses a family. The shelf price inches up 6 months later. If there's a floor, it's set by patient capital. Local operators with cash, community land trusts, and a handful of long-horizon owners who tie rent to income and term to soil health. But in a sell-off, patience is scarce. Speed sets price. And speed belongs to platforms wired for wire transfers, not to people who know the low spot that floods first. When the dust settles, the map looks different. Fewer owners, larger blocks, tighter terms. Debt shrinks on fund balance sheets and grows as invisible obligations on tenants who must hit KPIs to keep their ground. The crisis mechanics reset the chessboard. The next harvest grows inside those family farms to platforms. When the sell-off pauses, the map looks reorganized, not repaired. Parcels that once carried family names now sit inside platform portfolios with logos that read like infrastructure funds. Cash-rich consolidators moved fastest in the dip. They bought the tracks closest to highways, the blocks with water turnouts, the fields near processors. Speed set price, price set control. Families with patience couldn't match wire transfers. The deeds shifted first. The terms followed. Consolidators' advantage shows up in the first planting season. With lower bases, they don't need relief, they press. They recut leases across their new acreage, standardize templates, and roll KPIs from county to county. Volume deals with input suppliers arrive on schedule. A single chemical contract covers 5 states. Freight rates improve because loads consolidate at scale. The platform's operating margin widens even as individual fields wobble. That cushion lets them bid again when the next tract pops loose. Platformization doesn't just mean bigger farms. It means farms embedded in a larger machine. A logistics arm negotiates cold storage. An energy desk signs solar options on marginal corners and batteries against substation lines. A data group sells anonymized yield maps to seed companies and insurers. The field is still a field, but it now feeds a portfolio where cash flows mix: rent, power, credits, fees. When the crop is thin, another revenue line holds the quarter. That resilience reads well on investor calls. It also pulls acreage toward whatever serves the platform best, not necessarily what serves the county. Labor absorbs the shift immediately. Family farms that offered year-round jobs with a winter lull give way to seasonal contracts run by third-party crews. Operators rely on labor contractors who can scale across blocks, moving people like pallets. Pay depends on piece rates and peak windows. When weather shifts timing, hours vanish, then flood back under pressure. Benefits thin. Bargaining power follows size, and size no longer belongs to workers who live near the fields. It belongs to schedulers who live inside spreadsheets. Risk moves too. Insurance clauses that once named the landowner now name the tenant, with broader exclusions and tighter reporting. Storm hits? File fast, hit every date, or coverage narrows. Contracts carry liquidated damages for delivery misses pegged to processor timelines. Late by a week because the district cut water? Pay the fee. The platform's covenant stays clean because the lease channels the shock downward. Outsourced volatility becomes an operating principle. Policy, meanwhile, trails. Oversight stays fragmented. Agriculture under one agency, real estate under another, water under a patchwork of boards, labor under a fourth. The platform lives between categories and optimizes the gaps. Formal ownership disclosures remain thin in many states. Beneficial owners can be funds nested inside funds. Assessed values lag market swings. The then overcorrect when the next sale clears. Counties treat farmland like generic real estate because the statute says land, not soil. The regulatory language never learned to see a cover crop or a pumping cap. At hearings, the narrative resets. New funds promise resilience. They speak about drought-adjusted underwriting, climate-smart rotations, tenant partnerships. Some mean it. They pilot longer leases with shared downside on weather losses, tie a portion of rent to crop prices, and fund soil health projects that pay back over 5 years. But those are the exceptions. The default remains fee-driven. AUM pays today, appreciation pays tomorrow, tenants pay always. The same incentives, updated slides. A microscene marks the shift. A county supervisor asks a platform representative about keeping land in production after a run of conversions. The representative smiles. We're committed to agricultural excellence. The next week, graders arrive to prep an acre for a substation extension tied to a solar field on the back 40. The farm still plants the front, but now trucks share the road with transformer deliveries. The yield map shows a drop near the fence line. The NOI spreadsheet shows other income, smoothing it out. For smaller operators who remain, options shrink to 2 paths. Sign on as subtenants under platform terms or specialize into niches that platforms ignore. Heritage grains, direct-to-consumer boxes, CSA-linked rotations anchored by local buyers. The latter can work, but it needs long leases, patient lenders, and infrastructure. Mills, cold storage, shared wash and pack. That didn't survive the churn. Without support, niche becomes novelty, not a base. Communities learn the new rhythms. Tax receipts get spikier because sale prices print in waves while appraisals lag. School budgets learn to plan for cliffs. Volunteer firehouses hold more fundraisers. Local banks cede ground to national lenders who underwrite to platform balance sheets, not to a person they see at breakfast. The diner feels emptier at 6 a.m. The auction barn hosts more estate sales than cattle. Yet the ground hasn't forgotten how to grow. In a few counties, co-ops, land trusts, and public land banks step in. They buy distressed parcels, bundle long leases with soil metrics and water budgets, and offer rent participation on the downside when weather hits. Pensions with board-level resolve shift mandates toward these vehicles. More income sharing, less fee drag, transparency on tenants. It's slower capital, but it plants deeper. The returns won't light up a chart. They stabilize a place. Platforms aren't leaving. They're now part of the food system, with levers that reach from irrigation valves to supermarket pallets. The question is whether their terms keep ruling the field alone. After the sell-off, power consolidated by design. Rebalancing power will require design too. Contracts that give time back to soil, disclosures that show who owns what, lending that tests against farm income, not just comps. Otherwise, the next upswing will write the same lines, only thicker. Actionable countermoves, reducing fragility without fantasy. If platforms rewrote the terms, the counter isn't a slogan. It's contracts, credit, and sunlight. Start with leases, the hinge everything swings on. A lease can be a timer or a bridge. Make it a bridge. 3 to 7 year baseline terms with automatic extensions tied to soil health metrics. Not a brochure checklist, measurable targets. Increases in soil organic matter, residue cover, diversified rotations, verified water budgets. Hit them. The term rolls forward and rent escalators soften. Miss them because of drought verified by district data. Downside sharing kicks in. A temporary reduction or deferred rent that amortizes over the remaining term. That simple clause trades churn for stewardship without pretending weather is polite. Rent shouldn't float above the crop. Tie a share to income. Structure a base rent that covers financing plus a performance band pegged to crop prices or realized gross margins. If prices crater or a verified disaster hits, the band shrinks automatically. When prices rebound, owners earn back more. This isn't charity. It's volatility management that keeps tenants in place and fields productive, which protects valuation better than a revolving door. Put transparency where opacity lives. Beneficial ownership registries for farmland. State level first, federal if we're ambitious, so counties, lenders, tenants, and neighbors know who holds the deed and who signs the lease. Pair that with a standardized lease reporting system at the county recorder. Term length, presence of soil and water clauses, rent indexation method, and whether downside sharing exists. Not dollar amounts, structures. Markets behave differently when terms are visible. Short term, Extractive leases get harder to defend when the norm on the ledger is patient. Lending needs spine. Appraisal discipline starts with income coverage tests, not just comps. Requires stress tests at origination. 2 scenarios at least: price down 15%, water allocation down 20%, showing debt service coverage at the parcel and portfolio level. If lease terms are shorter than 3 years and lack downside sharing, raise haircuts on collateral values. If cap rates look thin relative to regional farm income trends, underwriting tightens or pricing rises. Exam teams at regional banks can make this routine. State regulators can bake it into guidance. Nobody bans optimism, they price it. Debt is a lever. Use it to reward time. Offer cheaper credit to owners who adopt soil-linked leases or income-sharing bans. State-level development banks or federal programs can create guarantee pools that reduce lenders' risk when financing long-term stewardship. Make the guarantee contingent on verified practices and lease structures. It's not new. Energy retrofits got there first. Agriculture can too. Public capital can anchor the market where it frays. Land banks and community land trusts aren't museum pieces. Equip them with right of first offer statutes for parcels above a distress threshold, triggered by a recorded notice of sale under time pressure or a covenant breach. The bank acquires, then issues long leases to local operators with soil and water metrics embedded, using blended finance, public seed, mission-aligned pensions, and local notes. Returns look like muni yields, not venture. That's fine. The point is stability that markets currently price but do not produce. Counties and states can add a preemption stoplight. When a buyer crosses concentration thresholds in a watershed or county, a review triggers, not to block growth, but to impose mitigations, mandatory long-term leases, water budgets aligned with basin plans, labor standards that reduce whiplash. Treat farm concentration like utilities. Essential services get oversight because externalities are real. Pensions don't have to exit, they have to re-specify. Mandates can require minimum average lease terms, income sharing, water caps aligned with basin rules, and fee structures that penalize churn. Tie a portion of manager compensation to verified tenant retention and soil metrics, not just AUM and appreciation. Require independent audits of agronomic outcomes alongside financials and publish them. Fiduciary duty includes the durability of the cash flow you're buying. Soil is the base case. Data can stop being a cudgel. If dashboards drive discipline, retune the KPIs, rotation diversity, water use efficiency versus allocation, soil cover days per year. Weight them as heavily as yield and lease renewals. If a basin enacts cuts, KPIs flex without penalizing compliance. The same software that enforced rigidity can score resilience. On insurance, cut the captive trap. If facilities or landlords require coverage, let tenants bring third-party policies, standardized and portable across leases. States can set fair dealing rules for embedded products, clear opt-out, standardized disclosures, loss ratios reported publicly. Climate risk warrants insurance. It doesn't warrant captive rent extraction. Markets need receipts. Build a farmland terms index, anonymous aggregation of lease lengths, rent indexation, downside sharing prevalence, soil clauses, reported quarterly by land-grant universities. Pair with a public dashboard of farm income-to-land value ratios by county. When those ratios slide, lenders, assessors, and boards see it in time to adjust before the spiral. None of this works if water is a rumor. Basin-level enforcement must catch up with climate. Adjudicate groundwater. Publish allocations and cuts in machine-readable formats. Enforce meters. Protect senior rights while designing equitable transition plans for juniors. Tie land finance to basin plans. If cuts deepen, loan terms flex or collateral haircuts apply. Finance shouldn't outrun physics. Last, reduce fragility at the edges where families live. Standardize grace in leases. Disaster clauses tied to verified events, mediation windows before termination, cure periods that account for weather and logistics. Create a state-backed tenant support line, short-term, low-interest advances to bridge verified shocks in return for documented stewardship. It's cheaper than the social cost of churn. These are not slogans. They're knobs you can turn without waiting for a perfect bill in Washington. Counties can adopt recording standards. States can pass disclosure and right of first offer laws. Banks can tighten guidance. Pensions can amend mandates. Owners can rewrite leases next season. When terms change, behavior changes. And when behavior changes, fields hold more water, tenants stay put, lenders sleep better, and grocery aisles stop carrying a surcharge for someone else's quarter. Personal Playbook, what viewers can do now. Start with your plate. Lock in CSA shares and buy seasonal. Cheap when fields are full, preserved when they're not. Build a small pantry buffer so you're not shopping into spikes. Join or start a co-op. Pre-buy programs anchor producers and smooth your costs. Shift some spend local, farmers markets, community mills, small processors. Stability lives in shorter chains. Push civically where it counts. State disclosure of beneficial farmland owners, lease term reporting, and water stewardship rules aligned with basin plans. Support land banks and right of first offer for working operators. For investments, screen out fee-chasing AG funds without soil terms. If your pension posts comment periods, ask for longer leases, income sharing, and soil metrics and mandates. Practice media hygiene. When you hear scarcity, look for income to valuation ratios, lease length, and water. Follow land grant data, not decks. This isn't purity. It's pressure and posture. Enough small weight in the right places to bend terms back toward use value. Resolution and broader meaning. When soil becomes a ticker, dinner turns into a dividend you quietly fund. Subscribe for receipts and solutions, then watch our deep dive on storage and insurance, the same fee engines shaping your monthly bills. Your next meal and your next bill start here.